Welcome to the Opening Bell Report.
Okay, so we have to talk about what happened in the market yesterday. I mean, Monday, February 9th, it was a sea of gray and red, mostly.
Mostly, except for this one massive green flare going off in the corner.
A flare is a good word for it. We're talking about AppLovin Corp, ticker symbol APP. And it didn't just, go up a little bit, it exploded. We're talking, over 13% in one day?
Over 13%. And it didn't stop at the closing bell either. It just kept climbing in after hours.
Right. It closed at $460.38, but then I saw it pushing past, $480 later on?
Yeah, the momentum was just incredible.
It's wild. But here's why we're doing this deep dive. This isn't just a stock went up story. This is a mystery. Because this is a company that hit an all-time high of nearly $750 last year.
Right, it was flying.
And then it just fell off a cliff. I mean, a complete crash down to around $400.
A brutal correction.
So now, it's suddenly roaring back. And the big question, our whole mission today, is try and figure out if this is a dead cat bounce, a final gasp, or if this is the start of a rocket ride right back to the top. I mean, is $500 next?
That is the billion-dollar question. And to get to an answer, we're not just guessing. We're digging into a really comprehensive AI ad tech growth analysis report that just came out. It's got the financials, the puzzling valuation, the charts, everything.
And the answer, it seems, isn't just about a stock price. It's about the plumbing of the internet.
That's a great way to put it. The report's whole argument is that this isn't just the mobile game company anymore. They've pivoted. They're an AI-first platform, and they're taking on the biggest names in tech.
They're going after Google and Meta.
At their own game, yeah.
Okay, so let's unpack this. Before we get into all the technical jargon, give us some context. How did we even get to this point of, such insane volatility?
You really have to go back to 2024 to get the full picture. That was their breakout year. They had this thesis that AI could target ads way better than people could. They launched their engine, AXON 1.0, and they were right. The stock went up something like 700%.
700%, wow.
Yeah, it was darling of the market. And then in 2025, it got even hotter. They rolled out AXON 2.0, which was a huge leap. And they started moving into e-commerce. That's when it hit those crazy highs, around $745.
The NVIDIA of ad tech, I think people were calling it?
Exactly. Everyone loved it.
Okay, so on top of the world, then the crash, it drops almost 45%. Why? If the tech was so good, why did everybody just sell?
One word. Fear. It was pure fear. The narrative on the street started to shift.
Fear of what?
The giants. The walled gardens. CloudX, Google, Meta. The whisper was that they were going to wake up and decide to crush AppLovin. That AppLovin's advantage was temporary.
The classic, you can't fight the final boss's anxiety?
Precisely. Investors got spooked. They figured AppLovin didn't have a real defensive moat, and the big guys would just copy their tech, and that would be the end of it.
But based on yesterday's move, it seems like the market's having second thoughts.
A massive reality check. The analysis calls yesterday's chart pattern a bullish engulfing reversal.
Okay, I love those technical terms. Break that down for us. What does that actually mean?
So visually, just picture it. Imagine the day before it was a red bar, meaning the stock went down.
Okay.
Then yesterday, the stock opens even lower. So for a minute, it looks like panic. But then buyers just swarm in. And they push the price up so much that the new green bar for the day completely swallows or engulfs the red bar from the day before.
So it wipes out the previous day's losses and then just keeps going.
Exactly. It's a sign of a complete psychological shift. The sellers are done and the buyers are firmly in control. And the report points out the volume was really heavy.
Meaning a lot of shares were trading hands?
Right. And high volume tells you it's not just, retail traders. This is institutional money. The big funds, the smart money, they're getting back in.
And they are getting back in right before earnings, which are tomorrow, February 11th.
No coincidences on Wall Street. That heavy buying suggests they've done their homework. They are positioning for good news.
Okay, so the panic is over. The big money is placing its bets. Let's talk about what they're actually buying. You said it's a mistake to think of them as just a mobile game company.
It's the most important distinction. I mean, that's like calling Amazon a bookstore. If you value them as a gaming ad network, the stock looks expensive because there's a ceiling. There are only so many people playing mobile games.
Right, a limited market.
But the report frames them as a premier AI-first ad tech platform. And the secret sauce is that AXON 2.0 engine we talked about.
AXON 2.0, so what does it actually do?
To put it simply, it uses machine learning to predict user engagement with. And the report calls it frightening accuracy.
Frightening accuracy. I like that phrase.
Yeah, it means they aren't just guessing anymore. The old way was to just spray ads everywhere and hope for a click. AXON 2.0 looks at millions of data points to know with a high degree of certainty who is going to click and who isn't.
So it knows I'm thinking about buying new running shoes before I even open a browser.
Pretty much. And because that predictive model is so good, advertisers will pay a premium for it. If you can basically guarantee a sale, the ad spend is a no-brainer.
It's all about efficiency.
Which brings us to the big picture. The analysis argues that AppLovin is seen as the only company out there right now that's successfully challenging the walled gardens.
Okay, let's define that term. Walled gardens. That's Meta in Google, basically.
Correct. It means they control the whole ecosystem. The users, the data, the ad space. If you wanted that high-quality AI targeting, you had to go to them. The rest of the internet news sites, other apps, that was the Wild West.
So AppLovin is basically bringing order to the chaos.
That's it. They've created a third option. They're telling advertisers, hey, you don't need to be inside Facebook's walls to get great results. We can find your customers anywhere.
That's a huge claim. But let's look at the numbers because the growth is it's wild. The report says last 12 months, revenue growth was 86.4%.
On a base of $6.6 billion in revenue.
86% growth on that scale that's staggering. Most companies that big are thrilled to get 20%.
It's defying the law of large numbers. As you get bigger, it's supposed to get harder to grow that fast. But they're still growing like a startup.
Okay, but I'll play devil's advocate. Revenue is vanity, profit is sanity. Anyone can grow revenue by just selling stuff at a loss.
And you are spot on. And that's where the report's crown jewel metric comes in. It's not revenue. It's the free cash flow margin.
Free cash flow. Okay, why is that the most important number to look at?
Because it's the real cash left over after you've paid for everything. Salaries, servers, taxes. It's the money you can actually put in the bank. And AppLovin's margin is 50.6%.
50.6. Wait, so for every dollar that comes in the door?
50 cents goes straight into the bank as pure cash profit.
That sounds ridiculously high. How does that compare to their competitors?
It's not even close. Let me put it this way. You look at a company like The Trade Desk, another Wall Street darling, incredible company. Their margin is about 24%. Unity is around 21%.
So AppLovin is literally twice as efficient at turning revenue into cash as its closest peers.
Exactly. And the report really zeroes in on why this matters so much. That giant pile of cash gives them this massive strategic moat.
And what do they do with all that cash?
Two things. First, they could do aggressive share buybacks. They've already reduced their share count down to about 340 million.
Which means each remaining share is worth more. My slice of the pie gets bigger.
Precisely.
Mm-hmm.
But the second part is even more important for this AI war we're talking about. They can self-fund all of their AI infrastructure. AI is incredibly expensive. You need data centers, thousands of these top-of-the-line GPUs. Most companies have to borrow money or sell more stock to pay for it all.
Which is really painful with interest rates where they are.
Correct. AppLovin doesn't need a loan. They don't need to dilute shareholders. They just write a check from their cash flow. They can out-innovate competitors because they don't have to ask a bank for permission.
That's a massive advantage. They can move faster than anyone.
It's huge. And just one more stat on that. Their return on equity is 258%.
258.
The report just calls it off-the-charts efficiency. Basically means for every dollar of shareholder equity, they're generating over $2.50 in profit. It's unheard of.
Okay, so they're a cash printing machine. I get it. But we have to talk about the elephant in the room, the valuation. The price to earnings ratio, the PE, is sitting around 55.
The steep number, yeah.
Steep. That's terrifying. I mean, traditional wisdom says anything over 25 is expensive. 55 sounds like a bubble. Isn't this stock just wildly overpriced?
And this is what the analysis calls the PE paradox. Because you're right. You look at a 55x PE, and your first instinct is to run away screaming.
Exactly. It looks like you're paying a massive premium.
But you're missing the context. And the report brings in the PEG ratio. Price earnings to growth.
Okay, walk me through the math. How does that make 55 not seem crazy?
So, yes, you're paying a 55 times premium on earnings. But what are you getting for that premium? You're getting 86% growth.
Okay.
Now, let's go back to the Trade Desk. Their PE is lower, around 30. So on the surface, it looks cheaper.
30 is definitely cheaper than 55, yeah.
But their growth is only about 21%. So with AppLovin, you're paying roughly double the PE, but you are getting 4 times the growth.
Ah, I see it now. You're not just buying the car, you're buying the engine.
Exactly. And when you actually calculate that PEG ratio, divide the PE by the growth rate, AppLovin comes in at under 0.7. And the rule of thumb is that anything under 1.0 is actually considered undervalued.
Wait a minute. So the report is basically saying that this stock, up 13% in a day, trading at 55 times earnings, is actually cheap.
It's calling it a value stock disguised as an expensive growth stock.
Yeah.
Because if that growth keeps up, that PE number shrinks incredibly fast. If their earnings double next year, your 55 PE becomes a 27 PE overnight.
That completely flips the script. It's just the market still isn't fully pricing in how sustainable this growth is.
Which brings us to the forecast. The stock's around $460 now. The big question from the top is $500 next.
Stocks do love those big round numbers.
They're like magnets. The report suggests $500 is the immediate technical target. And if it can break through that and hold it, the chart shows a pretty clear path to retest the $600 level. There's not a lot of resistance in between.
And we have the earnings catalyst tomorrow. The smart money is positioning for a beat and raise.
Right. They expect a beat on the numbers, but the raise is more important. That's raising the guidance, the forecast for the next quarter.
What's the one thing we should be listening for on that call?
E-commerce. If we can show that their AI is just as good at selling physical goods as it is at selling game downloads, then the whole potential market just explodes.
That's the real pivot, isn't it? From a gaming ad network to an everything ad network.
And that's when the ceiling just vanishes. That's why you see some of these Wall Street price targets as high as $860. That's another, 65% upside from here?
65%. That is a bold call.
It is. The consensus rating is a strong buy. A few analysts are literally calling the company an AI money printer.
I think I need an AI money printer in my office.
Don't we all?
Okay, so let's try to wrap this up. We have a stock that crashed because of fear of competition. But the business fundamentals, that 86% growth, and especially that 50% cash margin, they never wavered.
They actually got stronger. So the market dip seems to have been an irrational panic that's now correcting itself. The cash flow was always there.
And now we've got this technical reversal, this bullish engulfing candle, showing the big money is piling back in just in time for what they expect to be good news.
It's a textbook setup for a recovery.
So for you listening, whether you're an investor or not, what's the big lesson here?
It's about learning to separate market sentiment from business fundamentals.
Break that down.
Sentiment is feelings. It's the anxiety, the fear that Google's going to crush them. Sentiment changes with the wind. Fundamentals are facts. It's the 50 cents of profit for every dollar of revenue.
Sentiment is the weather, fundamentals are the climate.
Perfect analogy. If you followed sentiment, you probably panicked and sold at $400. If you followed the fundamentals, you saw that 50% cash margin, and you realized the stock was on sale.
A powerful takeaway. Look at the cash, not the crowd.
Always follow the cash.
All right, as we wrap this up, we always like to leave you with one final provocative thought. We've talked about how AppLovin is winning this AI ad war right now, but you have one more thing for us to chew on.
I do. Consider this. We know AppLovin is winning on the open internet. They're the predator in that pond. But as they get bigger and push more into e-commerce, they're not just fighting other ad networks. They are stepping onto the turf of retail giants.
They're poking some very big bears.
Very big bears. And with 50% cash margins, they have the ammo to fight. But the real question is this. What happens when the walled gardens of Meta and Google decide to stop ignoring them and actually fight back?
With their own next-gen AI.
Exactly. Google and Meta have data going back decades. AppLovin have the hot algorithm right now. But what happens when these trillion-dollar companies decide to unleash their full R&D might specifically to counter them?
So the next phase of this war is going to be the real test.
The next phase won't be about who's clever today. It'll be about who can sustain innovation when the competition gets truly, truly fierce. AppLovin has the cash, but the walled gardens, well, they have the castle.
A battle of titans. We'll be here to watch it. Thanks for listening to
Don't forget to like, share, and subscribe for more.